if you're trying to raise your typical seed, Series A, Series B, and so on, I think that capital stack is not always suited to it. And that, in conjunction with the fact that the adoption curves just took a lot longer, meant that we've ended up with companies and industries which have scaled less quickly than people had hoped, and less quickly than what they had planned for in terms of their capital. And that's reflected in valuations which now look potentially quite high relative to what they have achieved. And I do think that that's changing. So certainly what we see is that there is more discipline in capital allocation, and there's a much greater emphasis now on technologies that are actually growing and being adopted.
My name is Vinay. Thank you so much for joining me on the Sourcing Stack. Through this series, I speak with leading venture capital funds and investment firms across the UK and Europe. Today, I'm delighted to be joined by Emil, partner at Planet First Partners, a growth stage investment firm backing sustainable technologies and mission-driven businesses shaping the future of energy, industry, infrastructure, mobility, healthcare, and climate innovation. Planet First Partners takes a particularly differentiated approach to investing. As an Article 9 fund under the EU Sustainable Finance Disclosure Regulation, the firm invests exclusively in businesses that contribute meaningfully to environmental or social objectives, while also targeting strong commercial outcomes. The fund operates across multiple themes such as Industry 4.0, green cities, sustainable food systems, financial inclusion, and health. Emil brings deep experience across sustainability, growth investing, and climate technology, with prior experience spanning investment banking, structured finance, and clean tech investing. At Planet First, he has been involved in scaling companies operating at the frontier of industrial transformation, deep tech, and sustainable infrastructure. Emil, it's great to have you with us today on the Sourcing Stack.
Delighted to be here. Thank you.
Great. Now let's begin. Sustainable investing beyond the buzzword. Like Planet First describes itself as mission-driven growth equity fund, but also emphasizes delivering market rate returns. How do you think sustainable investing has evolved beyond ESG branding into a more serious investment discipline?
So it's, I guess, but through the phrasing of your question, I take it that you think that there was an issue, and I would partly agree with that. And I think it came down to a few things. So there was one part of it which was especially in like 2019 and 20, there was a much greater emphasis and awareness suddenly of these issues. And I think a lot of managers used ESG branding to appeal to a wider audience without necessarily integrating it that much into investment decisions. And ironically, I think those funds may have gone on to do better, because I think the second issue, which has been more fundamental, is that a lot of what you might call traditional climate tech is not really what venture funds have been very good at investing and scaling in over the last, certainly over the last 10, 15 years, where there was a lot of software consumer type investments. And a lot of these are like deep industrial, quite CapEx heavy plays. And if you're trying to raise your typical seed, Series A, Series B, and so on, I think that capital stack is not always suited to it. And that, in conjunction with the fact that the adoption curves just took a lot longer, meant that we've ended up with companies and industries which have scaled less quickly than people had hoped and less quickly than what they had planned for in terms of their capital. And that's reflected in valuations which now look potentially quite high relative to what they have achieved. And I do think that that's changing. So certainly what we see is that there is more discipline in capital allocation, and there's a much greater emphasis now on technologies that are actually growing and being adopted, and hopefully slightly more valuation discipline as well.
Great. I mean, yeah, so over the last 4 or 5 years, or particularly during the COVID times, the valuations were skyrocketing and not probably proportionate to what they've achieved. So yeah, it's greatly framed. Thank you. Now let's move on to the next question. Why sustainability is becoming an economic imperative? Say many investors still view sustainability as a sector. Do you think sustainability is now becoming a fundamental economic transition that will reshape every industry over the next decade?
It's a very interesting question, and obviously one we think a lot about. I think it's probably not entirely helpful to call sustainability a sector because it encompasses so many different things. It's a bit like talking about digitization in the early 2000s. There are spaces where there is real structural tailwinds. I think electrification of transport is one of those. If you look at the growth of electric vehicles, that's been phenomenal. And whether you look at countries like Norway, where it's partly driven by economic policy, or places like China, where it's partly also economic policy, but I think much more just consumer pull. That is a sector that is in transformation for sure. In other sectors, I think it's not yet the case. So there was a lot of enthusiasm around sustainable aviation fuel, for example. That's scaled very, very slowly and it's still very expensive. So I think we need to differentiate between different sectors. But certainly, I think every country in Europe and every major actor in Europe is rethinking how they operate. And whether that is due to energy security or supply chain resilience or environmental compliance, these things all come together. And I think we're starting to see much more an intersection of these themes, and those are the areas that scale. So one good example of this, I think, is data centers. So obviously, the AI boom now, there's massive build out of data centers. And anything that's more efficient, that saves power or more efficient cooling, or can bring down costs of construction, there's a strong economic imperative, but there's also a strong incentive for operators to adopt these technologies as a license to operate, because already we're seeing parts of the US banning new construction because of water usage, for example. So I do think it will happen, but I don't think it will be wholesale. I think it depends sector to sector what the specific conditions are. That's where investors have to be disciplined and careful about not just underwriting these hope values where, for example, green hydrogen in 2018, we saw a bunch of players and new funds. We have an investment in green hydrogen, and it's only now really that it's starting to scale, right? And this is multiple years later, and only in specific areas rather than, for example, hydrogen for transport.
That's very insightful, Emil. Now, Planet First focuses heavily on tech-enabled businesses solving systematic challenges. What characteristics make sustainability company truly scalable from your perspective?
So if I had to pick three, I would say unit economics that improve with volume. I think that's critical for any business that wants to scale. Defensible moat, which for us most often is technology, and a market that doesn't require a massive change in behavior to adopt. I think if those three conditions are there, then you have a good shot. And then there's a lot of other things that obviously play into it, capital, team, all the rest of it. But I do think the reason we focus on tech-enabled is it helps protect margins, right? I think it's hard to scale more commoditized business cases, especially if you're trying to be disciplined with capital. And in Europe at this point in time, you still need to be disciplined with capital.
Interesting. Now, a lot of climate industrial technologies require longer commercialization cycles than traditional software startups. How do you evaluate growth stage sustainability companies where the timelines and capital requirements are fundamentally different?
Yeah. So I think the first thing is everything needs to be framed a little bit in terms of risk return, right? So, for example, we have an investment in a fusion company, and we have a few quantum computing investments. Fusion company in particular is a very capital-intensive business, but we believe that the market and the impact and the value, should they succeed, is very large. And so from a risk-reward perspective, we're prepared to accept a bit more risk on the capital side versus something like a software play or any other type of business. That being said, I mean, capital efficiency matters more than I think a lot of people admit. You do have a more narrow window, and you underwrite differently. So when it comes to the more deep tech side of what we do, it's a lot more about evaluating risks with experts, looking at how we retire those risks over time, the economics of the first of a kind, the path to revenue or offtake, how that scales. And we do spend a lot more time on engineering and supply chain, not just financials. So manufacturing scale up, for example, plays a huge part in both Sunfire, which is a hydrogen electrolyzer business, and Commonwealth Fusion, which is the fusion business, for them to be able to commercialize and reach that. But you also need to be able to build a strong syndicate. I think growth equity alone is not enough most of the time. So in the case of CFS, obviously based in the US, they built a strong syndicate which includes strategics and investors that you typically wouldn't expect to see in venture-backed businesses. In the case of Sunfire, it's a large conglomerate of investors, includes strategics, but it also includes public funding in Germany and from the EU.
Right. Great. Now, the infrastructure layer of the energy transition, a significant part of the industry or the energy transition now depends on infrastructure, storage, grid, modernization, and industrial systems, right? Which parts of the transition stack do you think remain the most underestimated by investors globally?
So I think you can tackle this question in two ways. So on the one hand, you could say that parts of the transition and the infrastructure layer is well funded and is working well. It's mature now. So generation, for example, solar, wind, batteries. I think what's underestimated and which is harder to do is everything in between. So everything that relates to grid, for example, is not an area where infrastructure funds have played a huge part traditionally, because grid operators tend to be relatively centralized or regulated, whereas you can stand up a solar farm or wind farm relatively quickly, depending on their scale. And if you look at the queues now for generation assets, it's enormous. I think it's something like 2 terawatts in the US, for example. And every grid operator knows this. And it's not just about technology. So we spent a lot of time looking at grid tech companies, and we always came to the conclusion that what they're building is great, but it doesn't solve the problem. And so from a grid operator's perspective, that adoption has been very slow, because they know that what they need to do is just invest more in grid infrastructure. And that's that funding model I don't think is working at the moment, and data centers are just going to put an ever greater strain on this. So I think that's. I mean, I wouldn't say it's necessarily underappreciated because a lot of people talk about it, but not enough is being done. Industrial heat is probably another one that people have talked about for a long time, but not much has happened.
Interesting. I mean, these are very crucial insights, I must say. Now, Europe's position in the global sustainability race. Right? So Europe has become a major hub for climate innovation and industrial transition technologies. What advantages does Europe currently have in building globally important sustainability companies?
Europe has a phenomenal academic base and talent. If you look at the quality of teams that are spinning out from universities here in the UK, Cambridge, Oxford, Imperial, ETH in Switzerland, TU Delft, etc., Sweden, where I'm from, deserves a mention. We have the potential, we have the talent. I think the regulatory environment is favorable in the sense that it creates demand signals and quite a lot of forward visibility. The industrial base, I think we talk a lot about the decline of European industry, but there is still an industrial base, and that's important. If you take green steel, for example, there have been a couple of high-profile startups in Sweden. That would not have happened if you didn't have large steel manufacturers in northern Sweden. So we do have, I think, the conditions to create globally leading companies, and there are some examples of this also outside the sustainability space with what's going on in AI. But the greatest weakness, and this has been known for a very long time, is late-stage capital and exits. They're linked, right? Because I think with successful exits, investors get capital back that they can give back to managers to fund the next generation and so on. And it's hard to give a single reason for why that works, but I still think it's still true that most companies they're planning to get acquired by a US company, right, or try to list in the US. So that's probably where the weakness lies.
That's a very good perspective. Europe has historically produced world-class engineering, scientific research, and industrial talent too, particularly across the sustainability sectors such as energy, materials, manufacturing, and automotive systems. Great perspective. Now, on that front, when you mentioned that AI, energy, and industrial transformation. So AI is accelerating rapidly, but so are concerns around energy demand, infrastructure strain, and industrial efficiency. How do you think AI and sustainability intersect over the next decade?
Yeah. So sometimes I hear the perspective that AI is a big problem because it uses a lot of energy and water, but I actually view it differently. I think it's a great catalyst because, as I was alluding to earlier, you can't today build a coal-fired power plant next to a data center. So what's actually happening is that the hyperscalers are becoming the biggest and most aggressive buyers of clean power. So Google has a PPA with CFS. Microsoft is also, so they're backing these fusion businesses. They're standing up solar farms, and they're forcing a reindustrialization of the grid, right? Because AI is demanding so much power. So in many ways, I think this will be a great catalyst for scale and for upgrading the grid infrastructure. That's not to say there won't be problems along the way. And I think it's important that regulators and governments ensure that not every resource gets sucked up, but we use it as that scaling function. And on the other hand, AI and the capabilities, they're bringing everything forward. So CFS uses Google DeepMind for their plasma modeling in industrial systems, whether it's grid optimizations or materials discovery. precision manufacturing, AI touches a lot of these aspects. So they're definitely intersecting more and more. And I think some of the most exciting use cases for AI are within sustainability.
That's a very insightful response. Now, moving on to the measuring real sustainability impact. Planet First operates under Article 9 SFDR standards, which require rigorous sustainability assessment. How do you distinguish between companies creating measurable impact versus those simply positioning themselves around the sustainability narratives?
Yeah. So in Article 9 and our firm's interpretation of this is, on the one hand, there are certain areas where the EU has defined them as sustainable activities, and you have to prove certain technical thresholds. So within road transportation, you must have zero tailpipe emissions. There's a carbon threshold for hydrogen, for example, to be able to be called green. We don't look at companies, as I know some other funds do, in terms of like an overall carbon potential. We look much more at, fundamentally, is this activity a sustainable activity, and does it contribute to these goals? And then what we have to prove is the materiality and the measurement. So one aspect of this is that a lot of technologies that are enabling become harder to measure, and you can't be called sustainable simply because you're being powered by renewable energy, for example. So we have a partner who focuses a lot on this, and he knows a lot more than I do. But suffice it to say that we spend a lot of time with him when we look at businesses to make sure that what we're investing in can be measured. And we have a long list of KPIs that we measure and report on to our investors. Fundamentally, I think this is about transparency, so that investors are aware and know that what they're investing in, and that there are rules which the EU has provided that ensure that there's some form of common playbook, and that you can't spin or twist things, which I think was somewhat the case before, where you could come up with narratives around what qualified and didn't qualify without really having your homework checked. So that's how we think about it.
Great. It sounds like there's a major difference between sustainability storytelling and providing real-world impact with measurable thresholds and operational evidence. Thank you. Now, moving on to the next question. Founder quality in mission-driven companies. When you meet founders building sustainability-focused businesses, what separates those who successfully scale from those who struggle?
Yeah, I think there are many different types of founders who can scale successfully. So this is not to say that there's just one recipe for success, but if I think about some of the commonalities, if you start out with a vision and a mission of why rather than the what, I think that helps. And what I mean by that is, rather than think this is exactly what we need to do, how we need to do it, you say, I want to go and tackle this industry or this sector, and then you're more nimble on exactly how that works and why. Because I think it's important to be mission driven just to have that focus and belief, but you need to be able to do the commercial trade-offs, right? And you need to be able to make the hard decisions around cost down, accepting something that's good rather than perfect, and being pragmatic, I guess, rather than being too pure or idealistic. And then the other thing is, we obviously look for founders that have a fantastic belief in themselves and are tackling hard problems. But you need to be, I think, open to feedback and collaboration and coaching, because a lot of founders, especially in the more deep tech areas, they come typically from academic backgrounds or quite technical roles, and many of them have not been business leaders before, which is a different skill set. So just to stack your team with complementary talent, I think, is important, and to collaborate with investors who, we look at hundreds of companies every year, and we've invested in dozens and dozens of companies as investors. So there's a lot of cross-pollination and learning that you can do if you're open to it. I think that's good. And I would add one final point, which is I think you need to also be honest about the field you play in, and have a respect for your competitors. Rather than, I think it's great to have belief in yourself, but it can't be a blind belief in yourself.
Right. Very interesting perspective, insightful as well. Now moving on to the long-term thinking in venture capital. Planet First often invests in companies solving problems that may take years or even decades to fully unfold. Has venture capital become too focused on short-term outcomes and fast cycles?
It's a good question. I would say that we have tried to solve for this by having a fund structure that is evergreen. So we have pretty much a permanent capital base, and we have various ways in how we attribute returns and so on that allow us to take a more flexible and long-term view. Because I think what history has shown is that most investments, even we're slightly later, so we focus mostly on B and C stage companies. But certainly if you look at the early ones, most companies don't adhere to a 10+2 fund lifecycle. So you do need to be prepared to hold and support businesses for longer. There are also various factors at play. Exit markets might close. The various sectors, they operate on different cycles. Whether or not venture capitalists are too short term, I think in general they've been prepared to back relatively early bets. There's more pressure now, I think, just because exits have been far and few between. So I think a lot of funds want to show DPI. But there's not that much you can do. I think is one of this is the truthful answer as an investor all the time, because ultimately the business determines what you can do with it. That being said, I mean, yes, businesses I think are sold rather than bought most of the time. So investors and management have to work together to deliver good outcomes for investors, and it's important because it feeds that cycle. So if we can prove that we can build and exit businesses, like Fervos is great for the space, I think it gives investors capital back that they can reinvest, and we can go again. But yeah, I think a lot of businesses operate on a different cycle to venture capitalists. That's for sure true.
Great. This shows the significance of having a fund structure in place. Excellent. Now, coming to the end of this discussion, there's ongoing discussion around whether Europe has enough late-stage capital to retain and scale its ambitious technology companies. Do you think Europe is improving in supporting companies from innovation through to global scale?
I think it is improving. There's still a major gap between the US and Europe. And I think in particular, when we talk about the really large rounds or the really capital intensive sectors, we haven't had enough proof in Europe that we can exit companies at the levels where that makes sense. So, a lot of founders and funds think in terms of dilution. So if you want to raise 200 million, you probably want a 1 billion valuation, give or take. And if investors are wanting a 3 to 5x return on that, potential up to a 10x, how many examples of that do we have in Europe? Not many. So I think that is still a concern, and that's where people have to come up with other ways of doing it. So I don't think it's only about growth capital, but it would help for sure. I think the new initiative that EIC is doing is helpful, but we shouldn't be reliant on sovereign or government money. At the end of the day, I think the ecosystem and the economy needs to support itself. There is a different culture. I think when you speak to US LPs that have seen success in other funds, they're prepared to take more risk and write larger checks. And I think pension funds participating more in Europe would help. But we need to also show viable exit routes in order for that to happen. And I think more pan-European, right? There's still quite a big, Europe is fragmented, and I think it's great because you do need local knowledge and understanding of the economy. But looking too narrowly or not being able to, take companies out of one country and into another and grow them into more regional or European champions, I think is also one reason for this.
Interesting. I mean, good to know that it's improving, but as you said, Europe is fragmented, and it could be, a challenge at the end of the day. So thank you so much, Emil. This has been an incredibly insightful conversation. What really stood out throughout our discussion is that sustainability is no longer operating as a standalone theme or niche investment category. It's increasingly becoming a foundational transformation layer across energy, infrastructure, industry, manufacturing, mobility, and even AI itself. We spoke about commercialization challenges, long-term capital, industrial systems, regulation, deep tech, and the evolving role Europe may play in shaping the next generation of globally important sustainability companies. And one theme that consistently came through is that solving these challenges requires not just ambitious technology, but patient thinking, operational discipline, and founders willing to tackle genuinely hard problems. That's something that I really liked. Planet First approach, combining commercial rigor with measurable real-world impact, offers a very differentiated perspective on where the future of industrial technology and sustainability innovation is heading. Thank you again for joining us on the Sourcing Stack. I'm sure founders, operators, and even investors listening to this will take away a huge amount of the kind of knowledge from this discussion. Thank you so much again for joining us.
Thank you for having me.